Good afternoon, everyone. I hope you're enjoying your weekend. And what a crazy week or two it's been in the global financial markets, in the global economy, and the news cycle. Um, we've seen stocks bounce a little bit from those levels that I looked at in my charting video from a week ago. What I like to call magnet levels, key previous price levels that the market sort of gravitates to. And we've seen some bounce from those levels. And I think it was pretty predictable that they were going to find some bounce at key previous levels. Yes, I know Trump is acting like, I've joked with my clients that Trump is acting like Mr. Miyagi at the moment from Karate Kid, but instead of wax on, wax off, it's tariff on, tariff off. So let's have a look at the charts. Let's move that aside. But obviously, this tariff on, tariff off approach is causing havoc in financial markets. But let's have a look at the US market, the S&P 500. And this is a weekly candle chart. So this goes back and shows us the high from the end of 2021 to 2022. And this was a level that, and it's not just this market, I'll show you on multiple markets that they like to find key previous price levels that they are magnetized to those levels, hence why I like to call them magnet levels. I've never heard anyone else call them that, so maybe that's my thing. I'm sure someone else has thought of it, but you can see this key high from the end of 2021 to January 2022, and have a look at that. Now, you can't really see the candle wick, but you can see if I zoom in, there's a candle wick there. The US market came down to touch that exact level and then had quite a significant bounce. In fact, if we zoom into a daily chart, you can see from the low, it hit that exact level and it actually rallied back 13% from that low. So you can see why I was talking about, my previous video that I'm not calling a bottom in stocks by any means. But my clients and I went from a very low allocation to stocks to increasing our allocations on the way down. And we've looked at this in previous charting videos, but you can see the price was making higher all-time highs. Momentum indicators were negatively diverging. We saw the breakdown occur. The breakdown, there was an uptrend, and then the breakdown, the retest, and then the rollover. Now, one thing that if we're looking for where the market might come to, you can see the initial sell-off, there was a flagpole. Again, we looked at this in the previous video, flagging pattern, and of course that's a very bearish pattern, down as was this pattern, the negative divergence, down it goes. And you can see, so this is I would now say this is a major low for at least in the short term. Let's just remove all those and start again. You can see that low there, and it was respected again before the break. And then what happens? We see a recovery and it hits there. So I think the market's probably going to try and figure out, well, I think it'll sort of grind around this level for some time in the short term, trying to figure out whether it wants to resume the downtrend straight away or whether it wants to just kind of grind around at these levels. But you can see this, it makes sense that it would hit. If it gets a bit further, you could say this level here, around 5,800-ish almost. You had a previous key low there. What happened after the breakdown? It was respected again. So maybe we come back for a test here if we can get through this fifth level at 55.25 on the S&P 500. And we'll see the same on the NASDAQ, although, again, these are pretty similar sort of markets. A lot of the same stocks in the NASDAQ make up the S&P 500. So maybe this one not as relevant, but you can see again, NASDAQ comes back to that exact level that it peaked at the end of 2021. And you can see there was a little bounce there, and we're at that level again, another bounce. And if we zoom into a daily candle chart, we can see the NASDAQ had a bounce of about 15.5% from the low, maybe 16 if you take the intraday, the little candle wick. Same thing again. That was the key low. Look at that, and have a look at that. So when we had the first spill in the market, so we had this, negative divergence, markets rolling over, the spill, and then the return to the initial bounce level. That was definitely a dead cat bounce level. But you can see we return to these key. That's why these key levels are so important. I know it seems very basic, but I watch. I get clients send me charting videos from, especially channels that do crypto charting, and they do all this really, really fancy stuff. They've got 17 indicators on their charts. It's too much. Charting can be very simple. Don't overcomplicate something that can be quite basic. And it's not just, don't look at, the problem is people try and find 17 indicators on one chart. Like they'll look at the NASDAQ and they'll throw all these moving average lines and Fibonacci levels and all this stuff on the chart. But a better way to do it is not just look at the NASDAQ in isolation or if you're looking at Bitcoin or gold, compare it to what's going on in other markets that are either correlated or negatively correlated, and we'll come to that in a sec. We'll have a look at, so I think Bitcoin, for example, is a proxy for, I mean, it's a proxy for the NASDAQ, it's a proxy for stocks. So we're seeing over the weekend, Bitcoin breaking out of a falling wedge pattern, a bullish pattern. So that to me is an indication that maybe we're going to have a little bit of, or certainly to start the week, we're probably going to kick off with like a little rally in stocks, or that, maybe the Bitcoin chart breaking out is a sign that we are going to have maybe a 2 or 3 week recovery in stocks, maybe try and grind higher before the next leg down. But again, let's wait and see what opportunities the market presents us. Let's not try and read into the charts too much. They are a guide. They are not the be all and end all. And let's move across to the Russell 2000, which is generally smaller cap US stocks. So none of the, there's no Apple and Microsoft and that sort of thing in there. And what are we going to see again? We're going to see these key previous levels being respected. That was the high in 2000 and let me just come back to that for a sec. There we go. That was the high in 2018. It was the high just before the pandemic crash. Look at the bounces through 2022 through 2023. Yes, it did trade lower, but you would say that this level here, this blue line, and what happened? Well, it came down from and look at that, respected the peak from 2021 and then respected it again in 2024. Then it had a nearly 30% sell-off if you take the high to low, the spike low. And what happened? We're getting a bounce at that level. It found that level again, didn't it? I mean, it's just, it's simple. It doesn't mean that this is the bottom for stocks for the longer term. It just means that for me and my clients, I saw a significant correction and we increased our allocation to stocks. And we're probably going to see a little bit of buying support at these levels. We have already. It'll probably hold for a couple of weeks. We'll see. Trump can certainly throw a spanner in the works there. And then let's move across to the Australian market. And did we see something similar? Well, it's a little hard probably on your YouTube video to see that we had a candle spike down to about 71.50. Hopefully you can see that if I zoom in so we can remember it for later. Where was the high in 2020 before we had the pandemic crash? February 2020, 71.50. What did the market do? Come all the way back to that key previous level. That was previously an all-time high for the Australian market. And if you can see it came back to test it again. I'm just going to zoom in a bit so you can see this a bit better. Again, respected there, fell below, respected again, again. Lots of activity around this level. It was a key level. So again, the Aussie market, a completely different. Yes, the tariffs will touch us in Australia somewhat, but not to the same extent that it will the US economy, or for where obviously we're all connected globally. But you can see these markets, they want to find these levels, and the Aussie market, same thing. We had the flagpole, the bearish flag. That's a bearish pattern. Same thing again. This is why we reduced allocation to stocks. You had market making all-time highs, momentum indicators negatively diverging. Same thing we've looked at in previous videos. Now, what did the Aussie market do? After the initial spill found a bottom on the 14th of March. The market tried to rally back and then spilt again. What happened? That low there, markets rally back, respect that low. Now we might sort of try and grind a bit higher. And again, let's have a look at our key previous levels. I would say the 8,100 level, pretty important. It was a high there, resistance there, support again. All right. So if we're going to break out from this level, we'll probably go back to test 8,100 and then maybe some we'll reassess if we get there. But for the time being, markets are finding a little bit of a bounce. So, all these people calling for an 80, if you're Harry Dent, you're calling for a 95% crash in stocks. I think central banks would save this, not that they should, but I believe that they would save the stock market before it got that bad. US dollar, what a terrible time the US dollar is having. Again, you can see this same sort of thing where you've got a rising wedge pattern, negative pattern, big red candle breaking down from that pattern. And then if you zoom in, you can see the high for the move. Retest the high, sells off again. But same thing, as the price was making a higher high, momentum indicators negatively diverging, indicating to us that the uptrend was losing momentum. And US dollar is now closed the week below 100. That's not good for, well, depending on your perspective, not good for the US dollar. But this 100 level, very key. You can see the high in 2020. Look at every time it touches this 100 level, Now, yes, it did through 2021 trade a lot lower, but we know that generally speaking, over the last 2 years, anytime it's touched 100, what has it done? It's bounced, and it's had a fairly significant bounce each time. And the last one was quite significant. So again, this is not me calling for US dollar strength, just saying we should be aware of it when I'm making, when I'm making investment decisions for clients or helping clients with investment decisions. The US dollar is very important, and this is, it's had a nice sell-off now. So we just need to be wary of that. It can, if the US dollar were to rise again, it would put downward pressure on a lot of other asset classes. It's part of the reason why I've taken my clients from 20% allocation to gold or to precious metals in general, and we'll look at gold and silver in just a sec, down to a 10% allocation, mainly concentrated in physical gold. I want us to maintain a minimum 10% allocation, and gold has done very well, but we need to be wary of, we could have this big bounce in the US dollar, which would put downward pressure on gold. And let's go across to gold now. We can see gold has had an excellent run. That's a weekly chart, but just one more thing briefly on the US dollar. We can see, if I remove all the messy drawings I've done there, we do see the price making a sharply lower low. And what's starting to happen on the momentum indicators, they're starting to positively diverge. So it's a little bit early yet, and it didn't hold this previous low, or at least not at the moment. But there are signs that the downtrend, at least in the short term, the US dollar is starting to, it's probably a little bit overdone, starting to lose some momentum, something to be aware of. If we go to a daily chart on gold, we'll see the opposite. Now, gold has had an excellent run. I mean, it's closed on Saturday morning, our time, at an all-time record high. So during this, yes, stocks did bounce, but gold has gone up during this this stock market, this tariff crisis, wherever you want to label it, this stock market crash or mini crash. But what are we seeing now in gold? We saw a peak on the momentum indicators there back in February. So price making higher all-time highs, and also showing what I would call a broadening rising wedge. Excuse me, I have to sneeze really bad. Terrible timing. Oh, save that one for later. So this is generally a pretty sort of, that one's a little bit of an unusual pattern. I could make a case that that's a bearish pattern. The rising broadening wedge is not necessarily a bullish pattern. And even in the short term, you'd expect it to maybe swing down and test the 3,000 again. But what we are seeing is momentum indicators topping out, so showing some negative divergence as the price makes higher highs. So with gold at an all-time record high, showing US dollar showing signs that the downtrend may be losing momentum, gold showing that the uptrend, at least in the short term, is losing a bit of momentum. Again, I'm very positive on gold long term. I'm just being cautious. I'm managing risk for my clients. I'm making sure that we don't have our maximum exposure when any asset is at an all-time record high price. That was true for stocks late 2024 and to start this year. Stocks are at an all-time high. You don't want to have your full allocation. You want to manage risk, be in assets that are undervalued. Same with gold. I'm just managing risk. That's all I'm doing. I don't have a crystal ball. I don't know exactly where these are going. The Aussie dollar gold doing much better. Closed the week, didn't close right on the high, but I mean, well, it closed for a daily high, so we could say that was an all-time closing high for the Australian dollar. Now the momentum indicators here are making higher highs, so maybe you could say the RSI is starting to diverge. It tends to be a little bit more sensitive than the MACD. But look at that. I mean, that's just, I mean, how's that for a trend? Even if you take it back to, well, 18 months ago, I mean, what a steady, stable uptrend. Gold is in a very strong trend. And I've talked to a few traders who told me they were shorting gold a few weeks ago. And I agree with them that gold is probably overpriced in the short term, but this is a very stable, very strong uptrend. And think about all the turmoil that's going on in the world at the moment. Yet gold is maintaining a very steady, or you're probably seeing it, the camera in reverse, but you can see what I mean. Gold, amongst all this turmoil, gold is maintaining a very steady and strong uptrend. So that tells you, again, I've stressed the importance for years now that have something in gold, have 10 to 20%, depending on where prices are at. And when I say 20% in gold, that does include silver, platinum, precious metals, a little bit of silver, platinum, and palladium, and then gold mining stocks. But I've advised my clients to, and that was my mistake. I advised my clients to get out of their gold mining stocks because as gold was hitting record highs, I felt that we needed to reduce risk. Obviously, the mining stocks are riskier. Had we hung on to those, we would have made more money. But I stand by that decision. You're never going to know exactly where the tops and bottoms are. Manage risk. We maintained some allocation, so we're still doing well. Obviously, we could have done a little bit better had I hung on to those stocks for a bit longer. But I think at these price levels, makes sense to be uh, in the physical gold, in the safer of the precious metals investments. Now, this is silver. Now, silver is not looking as good on the chart, and this would be another reason why I've advised my clients to reduce risk in the precious metal space. Silver in this is a weekly chart now. You can see silver was in a rising wedge, and I showed this in previous videos. Rising wedge, which is a bearish or sell pattern. It broke out to a 13-year high. So again, something hitting not an all-time high, but a very significant long-term high price. You probably don't want to have your full allocation to an asset when it's hitting a significantly high price. We saw clear negative divergence on both the MACD and the RSI. I mean, this is a chart straight out of the textbook. And what happened 2 weeks ago, massive red candle, broke down from the wedge, and now it's returned. And look at that, it closed the week right at the bottom of the wedge. So you get the breakdown move, and we might be able to see it better on a daily chart. Look at that. You get the breakdown move, and then you return to the scene of the crime. I quite like that saying. You get the breakdown, and then what happens? Well, you broke down from that wedge, so you got to return to the scene of the crime to test it. For me, I hate to say it, I do think long-term silver is ridiculously underpriced. But if I'm looking at the charts agnostically and not having a bias or trying to eliminate any bias, if I didn't know this was silver, if I was just looking at a chart, I would say that this particular asset, XYZ, I don't know what it is. It has broken down. It's come back to test the breakdown, and it's probably going to do a bit of this again. You can see this $28 level, very key. It was the high in 2020. Respect it again, respect it again. Nearly got there. What happened once it got there? It consolidated for a bit, broke out, came back to test it, and now we came back to test it again. So maybe it needs another test. I'm neutral on silver here in the short term. I don't know where it's going right now, but I am advising my clients just to stick to the 10% in gold. If silver does dip, now that we've established some buying support at this 28 level, for clients who can tolerate a little more risk, if we did come back to test that level, so if we were to sell off from where we closed on Saturday morning, that's actually a 13% sell-off. If we got down there, I might say to clients who want a bit more risk and have a positive view of silver, precious metals, and are concerned about inflation, I might say, hey, let's add 5% allocation to silver, bringing our total precious metals allocation to 15%. But I would suggest that's a pretty aggressive level to be, or these levels, a little bit aggressive to be getting in just for the moment. But it's good that we now see that we've established a level. The 28 level has been tested and respected again, as it has many times in the past. And that's what I keep saying about these magnet levels, how important these previous price levels are. More so than all these flash indicators. Like, go watch some other charting videos on YouTube and have a look at the 17 different indicators that they like to use and how complex their charts look. Keep it simple. Don't pretend you're smarter than the market. You're not going to figure out some special trading system. Many before you have tried, and many people who manage billions of dollars have tried and failed miserably and lost 70 or 80%. Maybe you'll get lucky. Maybe you're smarter than me. If you are, best of luck to you. Now let's have a look at Bitcoin, and let's zoom into a daily chart. Again, we see these key levels. We looked at why Bitcoin was a major sell, triple top back in December, January, or well, more than a triple top, I guess, but at least 1, 2, and 3 major touches. What was happening to momentum indicators? Negatively diverging. It was clearly a sell. You had the key level at 92, the breakdown. But now what it did was during this sell-off, and it was a significant sell-off from the high to the low, it was about 31% if you capture the intraday highs and lows. But look at this falling wedge pattern, positive divergence. Notice how the price was making lower lows, MACD and RSI making higher lows. And this pattern, I said this to clients a couple of days ago, and this is consistent with stocks maybe finding a short-term bottom because Bitcoin tends to be correlated with the NASDAQ, with stocks. So we saw some buying support in US stocks, in Aussie stocks, European, Japanese stocks, which we'll quickly look at to finish the video. And you can see that it had touched this level, this downtrend, 1, 2, 3, 4, 5, 6 times, too many times. Once you start getting to 5, 6, 7 touches in a downtrend, uptrend, any kind of trend, something's going to break. And it did. So it's breaking out. So I would suggest there's probably a little bit more in here. Maybe it needs to come back to this 9150, 92,000 level to test that again. Did give it one test there and held. Depending on how quickly, if stocks are going to turn down again, Bitcoin might top out around the 88,000 level and then come back for another spill. But we know that there's some buying support now around this level. I don't have a long-term positive view on Bitcoin. I'm not a crypto believer. I'm just trying to look at the charts agnostically, and Bitcoin does have a place now in the global asset markets. So it's important we look at it, see what it's doing. It is giving us some indication over the weekend that we might see a bounce in stocks. I suspect that has something to do with, there was an announcement yesterday morning that Trump is going to exempt phones, computers, and chips, semiconductor, just chips you need for computers and electronic devices. They're going to be exempt from the tariffs, or paused from the tariffs. That's probably going to cause a little bit of a bounce in stocks, and Bitcoin is reflecting that over the weekend. Stock markets are closed, but we're seeing Bitcoin have a little bit of a climb in the short term. Doesn't look like much on the chart, but it is, that's a significant little breakout. It's probably 3% or so above the breakout level. So and holding for the moment. This is the Japanese market. Let's go to a 5-year chart. And you might not be able to see these candle wicks here, so I'll just zoom in to show you. You can see the big candle wick, the intra-week sell-off there and there. So have a look at that. So that low was respected. You got the low there, the candle wick, the low there. What happens when we zoom back? What a surprise. We see another key low there. So you can see that was a flagpole and a sort of a bullish flag formation. All right, so that flagging pattern was bullish, then it broke out. What did it do? Breaks out, return to the scene of the crime to test, and then up she goes. And then look at that big top there. Right, you had the price making a significant top, and then, but if we go back further to the highs in 2021, you can see again where did we find a bounce last week or this week that just ended at those key previous highs from 2021. I'm sure if we went back further, well, the Japanese market has recovered from significant lows, but you can see how these key previous levels continue to be respected. So, and then the Japanese market, nice little bounce, maybe about a 12% bounce or so. Now, it hasn't really got back to, there might be a little bit more left in this because there's a key low there. That is the same low we were looking at in other markets. The Japanese market, wow, it didn't have as much of a bounce, but their currency has been, because the US dollar's been weak, their currency's been a lot stronger. So I guess if you priced the Japanese market in US dollars, which have fallen, if you're a US investor, the Japanese market probably is effectively back to that level. But I haven't got one of those charts up to show that, but I'm sure you're happy to take my word for it. And this is a fund that I bought for some clients. And again, I cannot make recommendations on these videos. But I'm just giving you factual information about what I was doing. This is a fund that owns European markets essentially, but it's currency hedged. And you can see again what happened from the high to the spike low. It had about a 19% sell-off. So once I saw it down about 17%, in fact, I was looking at this level here. You can see the high from 2023, respected again there, respected again. So once I saw the market getting to this level, where it was as a key previous low, key previous level, that's when I thought, okay, well, this is maybe time to, because we're increasing our stock allocation, I want to maintain global diversification. So when I say I'm increasing my client's stock allocation, I don't mean I'm buying Nvidia and Tesla shares. I mean I'm buying global diversified funds, global markets. I'm not cherry picking companies at all. That's not part of my strategy. If that is your strategy, good luck to you. I think it's a guessing game. But you can see why that level made sense. Now, initially it did sell up a little bit further, but I'm pleased to say that I did well in this particular fund. I did buy some at the spike low, and the chart is looking a bit messy there. So there's not a whole lot to go on other than it had a big sell-off, and it did actually make if you look on the daily chart, you can see it did make, and that's why it's important to look at multiple timeframes, not to draw 17 different things on your chart necessarily, what indicators. You can draw lines on there if they're valid, but why it's important to look at a daily chart because it has broken those lows. So we're probably going to see some kind of bounce and then maybe a retest. So I'd be exercising caution there on that particular market. And that might be enough to look at for today. I can't actually see how long I've, oh, 25 minutes I've gone for. That's probably a good enough charting summary. Hopefully you've got some value out of this. And thanks for watching and look forward to updating you on the charts again soon. Cheers.